So I called Neal today because I had what I like to call an epiphany. How many of y'all know what an epiphany is? Raise your hand if you know what y'all laugh at me. I don't care. I call it an epiphany. It's all right. So, and all y'all that like, I'm still trying to get over Bernie. I want to have a weekend at his house. Anyway, sorry, I had an epiphany, right? And I also have a severe case of ADHD. But I saw this this video from this financial guy that I follow. His name's Jaspreet Singh. If you guys don't follow him, let me know. Shoot me a text, follow me, whatever. I'll send you a couple links to his videos. Super great guy. Yeah, Minority Mindset. Let's go, Orlando. You know what it's about. Or just search up Minority Mindset if you can't spell his name. Super dope dude to listen to, just to get some financial news or whatever. But I like watching it. Neal's got some other great stuff too. We'll cover that in a second. But one of the things that he mentioned was essentially talking about how Warren Buffett ended up essentially putting out a bet with all these other hedge fund companies. You guys know what I'm talking about? Y'all heard this before? Shake your head, yes, no, maybe. If your camera's off, I can't see you. No. Okay. So Warren Buffett actually issued a bet. First off, how many of y'all know who Warren Buffett is? Freaking godfather of finance, right? Like the guy. And he ended up coming up with a bet with all these hedge fund managers. And he was basically saying that they had all these massive fees and whatnot. And he just knew, beyond a shadow of a doubt, that nothing would be able to outpace any standard low fee type index. Okay. Like, brief commercial break. Somebody unmute and tell me, what do the IULs base their growth off of?
S&P?
Which is?
An index.
Hey, let's go. 2 points. Love you. Thank you. Appreciate you. But IUL base their growth off of indices, right? Or indexes. Indices is a fancy word to say indexes, right? And I'm scrambling on here to find this little example on my computer, right? Okay, I got it. Cool. So what happens is, Neal, would I be able to share my screen later? Is that okay?
Sure.
Okay. So what I essentially found was Warren Buffett, he came up with this bet with all these hedge fund guys, and he wanted to put his money where his mouth is. And he's like, look, if there's any hedge fund manager or any man-managed account or anybody else out there that can think they can outpace the market and think they can outperform my money, which is going to be in a simple index, I'm going to pay you $1 million. How many of y'all would take that bet? Bruh,
Yeah.
y'all just
If we knew what we were doing.
Yeah, y'all just lost $1 million real quick. Because this is what happened. They ended up running the bet for 10 years. Like, nobody would have taken it. Nobody took the bet, right? But one hedge fund manager with some massive gall, how we'll say it, essentially decided to say, you know what, Warren, I'll take you up on this bet. I think with my hedge fund, I think we can, like, in my man-managed account, I think we can beat what this index is going to do, right? Bernie already knows this is going, right?
Yeah.
I had 10 years to do it, right? In year 7, they threw in the towel. They said, no. They said, no, fool, I'm done. No, I can't do this. I can't outpace the S&P 500. I want to show you guys this as to how powerful this is. We're putting people, a little bit of a different strategy, but we're putting them in these indexes, right? So y'all, can y'all see my screen? Shake your head. Yep. Yes, no, maybe so.
Yep.
Okay, cool.
Yes.
What you see here, thank you for speaking up. Appreciate you guys. What you guys see here is the S&P 500, right? This index, the S&P 500. If somebody were to put 100 grand inside this index, okay? And if it were just to ride out this index all the way, like, again, indexes go up and down, right? They're heartbeats, right? Mm-hmm. So in the index that they would have had, like in the first year of 2000, and I won't go like full detail on this, but the index starts at 2000 and it goes all the way out to 2023. So I love showing my clients this, right? Somebody read that number for me. If they were to ride the S&P 500 by itself for 23 years, how much money would they have?
$324,604.
324 grand. This right here on this side is an indexed account. I got to move all y'all's floating heads are in the way. My goodness.
Make it bigger.
This right here is in an indexed account, or the same thing as an IUL. Okay. So when the market goes down, you don't lose anything. This is taking the best of what Warren Buffett was talking about and only allowing your money to move forward. So if you were to put your money inside an indexed account, still, but taking the best of both worlds and not getting any of the losses, but you still have your caps on the market as well. At the end of the 23rd year, how much money do you have here? Somebody read that out to me.
$493,295.64.
Which one would you rather have, Bernie?
The larger amount, of course.
So if I put you in that index account, would you let me have a weekend over at Bernie's? Would that be cool?
Absolutely. You'd
Bruh.
have a month.
Here's the better part, dude. This is the indexing strategy that Warren Buffett was talking about in a sense, but it's even better because we're using the IUL as a whole. So there are no downsides. What I mean by that is when the market ends up taking a dip, your money doesn't participate in it, right? So you get all the gains that the market goes up with, but if the market dips, you don't participate in any of the downsides, right? So in this simple illustration, if you would have had that same amount inside an IUL, you'd have had $493,295.64, and it's all tax-free. It's absolutely knucking futz.
So you had an epiphany this morning. You call up and you go, "Oh my God, am I the only one that doesn't know this?"
Bruh, I straight up, after I heard that bet and after I heard the Godfather of Finance took on every single major hedge fund manager out there with whoever had the cojones to challenge him on it, and nobody took him on it except for one person, and they had to throw in the towel after the 7th year. I'm like, why in the world is everybody else not taking advantage of a simple indexing account as opposed to just, you know, any other man-managed account or whatever? Because any other man-managed fund or man-managed firm or whatever you want to call it is not only going to eat them to death in fees, but the Forbes magazine even came out with an article after Warren Buffett ended up coming up with this, saying that a man-managed account cannot perform or outperform the S&P 500 5 years in a row consecutively, which is an index, which still means any other man-managed account from two different sources, Warren Buffett and Forbes, has said that nobody can outperform the S&P 500, which again is an index. And I started thinking, Neal, I'm like, bro, how are these man-managed accounts, how are these index funds still in business? Like, why? It's because people don't know about it. People don't tell them about it. And we have the most credibility in the world. We have the most power in the world to be able to tell these people this about making the wisest financial decisions in the world because we have a license to do it. You literally have, how many of y'all got a license on here? Raise your hand. You have a license to, not to kill. You've got a license to go write these policies, help these families. Your account will actually outperform any man-managed or hedge fund account out there. So it blew my freaking mind. And I'm like, this is even taking the index strategy one step further. And it's just like, man, it's taken what Warren Buffett said to another level because you're not participating in any of the downsides. You have less fees than what you'd have in a standard indexing account or index account. And it's tax-free. Like, it's getting the opportunity to have your cake and eat it too. And I'm just like, the reason why I'm so excited about it, I'm not trying to oversell anything. I'm just more excited myself on it because I know I'm doing the right thing for every single one of my clients. And I'm convinced there's nothing better out there. There's absolutely nothing better out there. And whenever you get that conviction, it makes it easier to sell these policies for these. And I don't even want to say sell because I almost feel like not to get all humanitarian on it or whatever, but I'm rescuing them from making a bad decision for themselves. Like mom, pop, uncle, sister, aunt, cousins, brothers, twice removed sister or whatever is going to tell them, put your money in 401k, put your money in a Roth, put it in whatever. But in actuality, the main dude that's got more money than all of us is saying, hey, put it in an index fund. And we've got the next best thing. So that's
that's excellent. And
I get excited about that. But yeah.
Well, and so Tucker did an interview with the Wolf of Wall Street. And if you remember, Leonardo DiCaprio played him. He knows both sides of the market because he wasn't, back then, he was not a legit dude. He did some stuff that landed him in jail. But being interviewed when he got out of jail, his brother-in-law had started day trading his own account and lost most of the money because he listened to people on TV. And he says, look, you cannot time the market, but the way to beat the market is get a low fee indexed account, leave your money in there for 10, 20, 30 years. That's how you beat the S&P 500. So that link is in there. And Daniel, if you want to put that other guy's link in there so people can, you can just click on it. You got access to the videos. So excellent.
The Sing video.
What's that?
The minority mindset video.
Yeah, it's really good. So that's what you got your hands on. You have insurance companies indexed to the market, but they don't put your money in the market. So be confident. that you're putting people in a good vehicle, number one. Now, number two, there's this thing called term insurance. And I made a statement, I'll never write a term policy again. But I've changed that because we had a conversation and Alicia got the details on it. And so I want her to talk for a couple minutes on a term conversion because and how that fits, because not everybody can afford an IUL. So Alicia, are you there?
I'm here.
All right. So why don't you just share kind of your experience and what you found and what the solution was and what you found out about the term conversions.
Absolutely. Thank you, Neal. Hi, everyone. So, hi. I wanted to talk to you about term conversions and just kind of step back for a minute as to what they are. A lot of you probably are familiar. I had a situation where I had a couple that they're getting ready to buy a house, and they're in the shopping process. They're hoping that the rates drop a little bit, like so many people in the U.S. are now. And they really believe in the IULs, and they really want to do these, but they just wanted to wait a minute until they know what their mortgage payment is going to be as to what house they buy. So in that, I'm like, okay, so let's really look at this. And I was thinking about the term conversion, because what I will be able to do on Saturday, they're going to do terms, and then they're going to convert them to the IULs once they buy the house and they know what their budget is. A couple of reasons this is good for anyone that's not familiar. Basically, if you get a term policy and then you convert it to an IUL in the future, what happens is you go through underwriting once. Okay, so for their instance, let's say it is a year, maybe 2 years before they buy this house. You do not have to go to underwriting again. You get underwritten with an LG the first time with the term policy, and they're going to do $500,000 for each of them. Okay, so now a year down the road, when they get their house and they go to convert this to an IUL, they do not have to go through any of that process again, and they can just convert it right in LG to an IUL. Saves a lot of time. It fits their budget now. It gives them the coverage that they need now, and gives them the ability to convert that. It is such a simple process. All the qualifying parameters are the same. So this is not going to be a fit for someone that won't qualify for an IUL. It's not that type of client. It's for someone that has a monetary situation right now that they can't full on go into the IUL. Even if they wait, if they sign up for a 20-year term, if they wait 10 years, they are still under the underwriting that they received, let's say at age 25.
Go ahead.
They're under the same qualifications they got at age 25 versus 35. And that's why it suits. Again, it's not for every client, but if you run into a situation like this, where they only have a budget of this much, but they really love what an IUL will do, and they foresee having a higher budget in the future, this is something you're going to want to know about, and this is going to save them and take care of what you need.
Yeah, so just to expand on that, so 15 years down the road, they get sick. They get some condition that would make them uninsurable. They can still convert it to an IUL, and there's no health check. They automatically qualify.
Exactly. They have so many years within, if they decide to go with a 20-year term, 30-year term, whatever it is, they have at least halfway into it that they can convert it to an IUL. Absolutely.
That is amazing. So when someone just doesn't have the money, like I've run into people, they're like, hey, I pay off my car, next summer, it's paid for. So you write them a term policy and then convert it, because they'll say my car payment's $400 a month, but I don't have an extra $400 a month. Write them a term policy, and then once they pay their car off and they have that extra capital, then convert it to an IUL. That's kind of what we're saying. That's the purpose of it. So that is awesome. I never knew what a term conversion was. But I appreciate you calling the company, getting the details. How and I don't know if you know this or not, but to what degree can they pay? Like if they're paying $200 a month, what can they increase their payment as long as the overall insurance amount doesn't go up?
They can, and they can convert the whole amount of what they have or part of it. So they're going to both get $500,000, like I said. So when they get that $500,000, when they go to convert it, if they just want to convert 300,000 into an IUL, they can. They have that choice. They can do whatever amount that they want. They can do the full 500,000, whatever they want. They can do that. So you can fit into their new budget. So if max funding a $500,000 IUL isn't within budget, but a $300,000 IUL is, then you can do it. So they can be within that range of whatever they got on the term.
Very cool. That is awesome. I never knew that. That'll come in handy. I've missed a couple of sales because of that. Well, I'll circle back with you next August. So and also the reason that's important is that we get paid on the insurance amount. So in a lot of cases, you can get a bigger commission and covering them with a term policy than you can with a straight IUL, depending on what they contribute. So, yeah, way to go. You are on fire. I'm going to just say that. So,
thank you, sir.
Miss Christopher. So the next thing I want to do, and then we'll get to the illustrations, is I want Felipe to talk a little bit. He, I think, had an epiphany on getting referrals. So, Felipe, are you out there?
Yeah, I'm right here, Neal. Thank you.
Yeah, so just share with everybody the story that you told me because it was pretty amazing.
Yeah, so this past weekend I was at a wedding and I had a gentleman that I met there and he asked me, hey, like, short conversation, what do you do for a living? And I told him, I help people plan for, I help people protect themselves while securing their financial future. And he was kind of like, so what is that? Tell me a little bit more about that. And we talked about everything, all the benefits of the IUL. And he kind of like what Daniel was saying, he had an epiphany. He was like, wait, what? I can do that with that? I can have, with an IUL, I could do this, I could do that. It was just kind of like an aha moment for him. And it was also an aha moment for me because, I'm a new agent and the big misconception with life insurance is that people think they only need it when they die, or they can use it only when they die. And just me being comfortable and knowing and being knowledgeable about the IUL and explaining it to him and seeing his eyes kind of like light up and understand, all the benefits and to be able to have that tax-free retirement and all that stuff was mind-blowing for him. We exchanged numbers. He called me Monday and he's like, hey man, I really want to do this for me and my wife. We got on a Zoom Tuesday and we both of them a policy. And he was like, this could work for my kids too, right? And he's like, yeah. He's like, okay, can we do it this weekend for my kids? He has 4 kids. He's like, can we do this too for my kids? And I said, of course. And he was like, great, let's do it this weekend. If not Sunday, let's do it. And I told him, great. And I said, I like to always, obviously, like Neal says about referrals, but I like telling him, can you introduce me to someone that can benefit from this the way you did today, instead of asking straight for a referral? Because I think an introduction holds way more weight than you just getting a phone number. An introduction, it holds volumes because now you're already building that trust from someone they originally already know. So if they're telling them, hey, my buddy, this is my buddy, this is so-and-so, this is what he was able to do for me and my family. This is him, this is, Felipe. He gives you that introduction. And I think that speaks volumes. And now he introduced me to 2 people that he works with that want to do the same thing. So it's just huge. And I thought that was a great encounter. And that just took me from, 2 policies to now 6, possible policies. And from just one day to a simple conversation and having that aha moment as a new agent to be able to show somebody that and their eyes light up, it felt really good. So
that's awesome. So say that one more time. What did you tell the guy originally that you do?
I told him that I help people protect themselves while securing their financial future.
Wow.
And that kind of made him, think like, so tell me about that, how or what? And then that's when you get into an IUL.
That's awesome. So just having the courage really to open your mouth and have something memorized that you can just tell people is amazing. So
Yeah, because if you just tell someone, hey, I do life insurance, then it's just kind of like, oh, okay. And then the conversation could die there because the misconception is you only need life insurance, when when you pass away. There's people don't know about that living benefit, or they don't know that they can set themselves up for a tax-free retirement. So that kind of just segues into that instead of just saying, I do life insurance.
So now you're booking like a wedding crasher, you're booking wedding appointments.
I'm looking online for like next weddings. That's it.
Yeah. He's going to be the Will Ferrell of the group, wedding crashers. I love it. Well, thank you for sharing that, Felipe.
Thanks,
I appreciate
Thank
that.
you.
So that's probably the trickiest part of the business right there. If you can get that down, there's some people, they never buy leads. All they do is do referrals. It's amazing. One of the challenging parts, and I think Francis is going to cover just writing illustrations, because the first time you do it with a client, it's a lot simpler than you might think. You don't have to make it difficult. The more difficult you make it, the more difficult it's going to be for the client to make a decision. So what we're going to do is we're going to do illustrations 101. Francis, I made you a co-host, so you should be able to share your screen and go over that. And I think you're muted. Unless you're going to do this old fashioned.
Can do a little sign language.
Yeah, a little sign language. This
All
needs
right.
no narration, right?
So good to see everybody. Glad you guys could make it. You need to be a student of the business to do well in this. I'm going to use National Life Group mainly because most of us do write National Life Group. I did write 2 F&G
Francis?
policies. Yes.
Can I just rudely interrupt you for 1 second and beg you to go back to that last screen, because I want to point something out to everybody, please? I promise it's for a good reason.
Okay.
The guy that's talking to you now, I want everyone to take a second and look at what his in-force business is for this year so far. He's over $1.2 million so far this year. He knows what he's talking about. So you got one of the best right here talking to you. Thank you so much, Francis. And thank you.
Thanks,
for sharing.
Alicia.
You're welcome. I just wanted everyone to see that number and how amazing that is. So you go, man. Thank you.
So if you guys, the reason, there's a lot of reasons we use National Life Group. National Life Group is just a super quality company. Their integrity is high. The people who run the company has a high integrity. It's just, there's so many good things. But what we really like about them is how easy it is to use National Life Group. So if you look right here in this upper right corner, this illustration, you just click it. You go from the illustration to the application. I wrote 2 F&G policies today. You have to go to one area and do an illustration. You have to go to another area and do an application. You have to upload the illustration to the application. It's a pain in the butt. Let me just tell you. Mutual of Omaha, you got to go to a third party. There's the ease of National Life Group is so nice. It's just amazing.
But you did get a felon covered. I did
get a felon covered and a mom and a daughter. Well, it's all pending, but I wrote them F&G for another reason. But anyways, so now this is National Life Group. Click on the illustration. It's going to bring you to here. And here you're going to be up here in this activities in upper left hand, and you're going to go right to this new illustration. Okay. Pretty simple. You click on it. And then you pick whatever state. It's going to automatically default with your resident state. Georgia, Tennessee, California, wherever you are. Now, if you're working with someone in a different state, you got to pick that state. Okay. So mine is Tennessee. I live in Tennessee. So this is my resident. I'm just going to leave it there. 99.9% of the time, you're going to use this top selection here, Flex Life. Okay, 2019 Flex Life. Rule of thumb with National Life Group, you only do the LSW. LSW stands for Life Insurance of the Southwest. Don't know why it's the LSW compared to the NL. NL is only New York. So I wish they would reprogram this so we don't ever see New York. But if you look at New York State, it's only NL. So these NLs don't ever do an NL unless somebody lives in New York and you're licensed in New York and you're writing a policy in New York. Otherwise, every other state, all 49 other states are going to be, I'll just pick another one, Illinois. All 49 other states are LSW. So just remember, you're only doing LSW when it comes to National Life Group. Now, while I'm on this, I'll just kind of go over this real quick. You're going to use this Flex Life 99.9% of the times. If you have somebody who's high income and the policy starts at a face amount over $1 million, you're going to use this Summit Life. Neal and Alicia were talking about a term and term conversion. National Life Group has a great term, and especially with the way you can convert it, it's probably one of the best ones out there, the living benefits, etc. So you have this LSW term right here is what you would use. Again, stay away from the NL. You're only going to do this LSW. So this is their term, 10-year, 15-year, 20-year, 30-year, and annual renewing term. This is awesome. If somebody has like a huge loan that they're only going to have it for 3, 4, 5 years, you can do this ART. It's about the cheapest thing out there on the market. So great product. And then these are annuities down here once you get below this whole life. I've never written a whole life with National Life Group, so I don't know much about their whole life, but these are annuities down here. These bottom two are variable annuities, which you would use if somebody didn't qualify for an IUL. You could use a fit secure growth or fit select income. We'd go over that in another day. All right, so we're going to click on Flex Life. Pretty simple. It's going to open up. You're going to put the person's name in. Bill Smith. They have a middle initial, say T. You're going to put a middle initial. It does say middle name. I just use the initial. You can put the whole name, Is it a male, female? What's the date of birth? Okay. If you see here, if you don't touch this, you can see this IGO e-app stays black. But if I put a date in it, 07, 22, 22, 1982. Okay. So 42-year-old, this now turns green. So now once I do the illustration, I can go straight to the app over here on the left where you see this IGO e-app just turned green. Okay. We're going to come down here. We're going to look at what race class. Are they a smoker, non-smoker? Okay. 99%. It's amazing how many people don't smoke anymore. So you get a ton of non-smokers. Every now and then you might have to pick standard smoker. I suggest you always do standard. You're gonna put in an application as standard non-smoker, and you're gonna get people approved as elite. You're gonna get people approved as preferred, select, and standard. You're also gonna get sometimes people approved as express standard. That's 1 below standard. Express standard 2, that's 2 below standard, and then beyond that they're declined. And then you get into tobacco. So for the most part, all you do is just ask them, hey, you a smoker, non-smoker? I'm a non-smoker. Then do it standard non-smoker. It's not non-tobacco. Okay. Then you're going to come over here to this death benefit funding. All right. Right below client information, we're going to go to death benefit funding. When we click on that, this top section up here, you don't do anything with. Just leave it defaulted. Guideline premium test, none. Just leave this the way it is. Don't even touch it. You're going to come down to this death benefit, this face amount right here. Okay. There's different selections that you can select with your face amount. All right. 99.9% of the time, you're going to use minimum death benefit, maximum cash value. Why? Because this reduces the amount of life insurance to the lowest amount that the IRS will allow, giving you the most cash growth inside the policy. So that's super important. Most people who are looking at an IUL are looking at it for both life insurance as well as tax-free retirement. Some of them, the life insurance is just a byproduct. So that's why we're using this minimum death, maximum cash value. Okay. Sometimes you have young kids and they need more life insurance. You have a family with young kids. Well, you might want to do balanced death benefit. Okay. Or you're going to do minimum and keep it at level, and you're not going to increase it. Because if you increase it, it's going to give them like no life insurance to start with. And it only gives them maybe 20, 30,000 of extra cash growth over 30 years. So yeah, it's more cash growth, but their family's not protected. So again, you got to figure out what the client wants and that kind of thing. But most of the time, you're going to leave this as level. You can go to increased, but I would leave this in level unless they're in their 20s and they don't have any kids. Then you can increase it. You can increase it 1 year or equal to or 1 year past when they're funding it. All right. So that's your face amount. How is the face amount calculated? It's going to be calculated through this minimum death max cash value. All right. Then it's a matter of the premium. Okay. This is all about the premium right here. See, it says premium. How are they going to fund it? Are they going to do it annually? Do they get a bonus once a year? Or are they going to do it like their normal monthly bills, and however much they're stashing each month, they're going to put into here instead of into the bank account or in some other funds. So most of the people I'll ask, would you like to fund this annually or monthly? Or how do you want me to show this to you, annually or monthly? I'll ask it different ways, and they'll come back and most people say monthly. So then you're going to come down here to where it says target premium. You're going to hit this drop down and go to specify amount. Okay, that 100% of the time you're changing this target premium to specify an amount. And then you're going to find out how much they put in. Mo, who Amjadi, he's on Juan's team. He does a great job, writes a ton of business. And what he does is he says he wants to show them the most that they can put in. Okay. And the most that somebody can put in is 10% of their annual income. All right. Now, there are ways around that. Okay. It depends on their net worth and things like that. Because, yeah, you got some people that'll put, like the lady that myself put 600,000 a year in, it's her net worth and other things that allowed that to go in. So, but rule of thumb is 10%. So if somebody's making $120,000 a year, well, that's $1,000 a month. Okay, that they can put in $12,000, $1,000 a month, $12,000 a year. That's 10% of 120,000. So if the person's making 120,000, or if they're making 60,000, okay, you might put 500. That's 6,000 a year. So 10% of their annual income. That's the most that we can put in. Let me show you, so you can tell them, hey, let me show you the most money, the most that National Life Group will allow you to put in, and just kind of leave it at that. Okay. And so let's say they're making 60,000 a year, and we're going to put $500 a month in. All right. That's the most that we can do for them. And then I pick a default year. I tell them, all right, so we're going to do this till age 67. And the reason I use 67 is that's when you can draw full Social Security. People can start drawing Social Security at, 60, 62, 63, but they only get a percentage of what's totally available to them. But at age 67, they get the full 100%, amount. Well, a lot of times people, they wait till that full 100%, and so you don't want to be adding. And if you're fully retired at age 67, you don't want to be putting money into this thing. And I'll tell them, I said, you can stop it at age 60 or 65. I just use this as a default. So now we have how long you put the money in for, how much money. Then we're going to go over here to this quick view. Pretty simple. Just click right there. And you'll see that you're going to end up going back and forth between death benefit and funding, making a change, maybe coming back to quick view, going back to death benefit funding, and until you get it just right. And then, it's a matter of just explaining the illustration to them. I don't explain a lot up here. Okay. There's a lot going on. If I asked every one of you what minimum premium, death benefit protection premium, target premium, MEC premium, guideline level premium, you all would have different answers. Most of you'd be raising your hand like, I don't know what that is. Okay. Well, I suggest you look it up, learn it. Okay. I'm not going to go into what it is, but look it up. I'm not going to confuse my client. I'm not even going to touch these things. Okay. The only thing I touch down here is I will go over the MEC premium. If they ask me a question, hey, can I put more money into it than what I'm put than the 6,000? Yes, over time. Like if I get a bonus, can I put that in? Yes, you can. But you can only put in up to, I tell them this MEC premium right here, you can only put in up to $19,976. All right. That's the most you could put in any 1 year. That's about all I will tell them about down here. I start off with the face amount. So $500 a month bill is going to get you $309,248 of life insurance. Your initial face amount is the life insurance amount of this policy. And then I say, look, it's not going to lapse. It's going to take you to the end of life. You can't outlive this. Then you have your MEC year. Most of the time, I don't even, that's it. I go over initial face amount, lapse year. Then I go just like this, drop it down. I say, okay, now let's go over how this works. And I'll ask them, oh, you're on a cell phone. Can you see that? Well, not really. Well, I go Control Plus. And I'm going to make it really big for them because they're on a cell phone. Can you see that? Oh, yeah, thanks. Okay. You can blow it up just by hitting Control Plus or Control Minus brings us back. All right. So just FYI, you didn't know that. Now you do. So over here, I'll say over here on the left, you got your policy year, your age. This is your planned premium, or you could say annual premium. $500 a month times 12 is $6,000 a year. This is your annual premium. And remember, I showed you we're going to pay it until age 67. So from 68 on, and then I'll scroll down, I'll show them. You're not putting any more money in. This is a paid up policy. You'll never put another dime into it. Oh, okay. And so they see the zeros and they kind of understand that. And then I direct them to this next column. This is your accumulation value. So this column here is the cash that accumulates inside the policy. This column only goes up, never goes down, never goes backwards. Doesn't matter what's happening to the stock market. Doesn't matter what's happening in the world. Doesn't matter if you're pulling money out of the policy. This column never goes down. It goes up based on premiums paid in and interest earned each year. Okay, so you're getting both. So then what about when you stop putting money in? Well, guess what? It's still generating interest, and it's going to keep generating interest every single year. You can't turn it off until you die. All right. Or you make it to 120 or beyond. And if you make it to 120, you got $9 million you get to play with. Okay. Because it would have built $9 million. You'll have accumulated $9 million by the time you're 120. Then I say, so this next column is your surrender value. Now, this column is your bank. This is the money you're able to use inside the policy. So let's just say, for example, you have $13,968 or $13,689 in your surrender value. And let's just say maybe there's this small rental property. It's $100,000 and you need to put 10% down on. Or it's $200,000 and you need to put 5%, whatever. You need $10,000 and you're going to pull $10,000 out of your surrender value. And if you pull $10,000 out of this $13,689, you're going to surrender that amount from the death benefit. So this last column over here is your death benefit. So if you take the $10,000 from this $13,689, that's going to reduce this $309,000 down to $299,000. Okay. You just surrendered $10,000 from the death benefit. And I'll ask them, did you follow me? Does that make sense? I'll ask it different ways. And most of the time, yeah. Or they'll ask a question. It's like, yeah, I'm with you. Okay. As I mentioned before, accumulation value does not go down. So this 19,000, you're still generating interest on 19,000, 24,000, 30,000, 36,000, even if you never paid that $10,000 back. You're still generating interest over here on your accumulation value. And that's how people use this as being their own bank. So think about how a bank works. They borrow from the Federal Reserve at a low rate. They lend to the public at a higher rate. Then they make the spread. That's their profit. You're doing the same thing right here. You borrowed at 10,000 from your surrender value. You borrowed it surrendered it from the net death benefit, and you're making a higher amount on your accumulation value. So you're making the spread at $10,000. And you can do that over and over and over and over, okay, throughout the life of the policy. But I always suggest to my clients, as you're paying into the policy, pay yourself back. Why? Because if you don't, you're not going to have this money down here, this 316, 360, 460, you're not going to have this in retirement if you never pay yourself back. You're going to be short. And then I'll show them. I can show them right here. So this is your death benefit. Now, this is a level death benefit, meaning it stays the same, 309, 248 all the way until, as you can see here, when your accumulation value gets to the point, it starts pushing up the death benefit, 309, 324, 350, 370. It's going to keep growing. And it's going to grow. Let's say you pass away at age 90, okay? Well, you're leaving a $1.3 million death benefit to your family. That's how people pass on generational wealth. And they're like, oh, okay. And that's pretty much, and then let me finish off. So then I'll say, well, let me show you one more thing. I'll ask if they have any questions. If they don't have any questions, I'll say, well, I'll hit the reports here and I'll say, well, let me just show you one more thing. National Life Group. I used to say they like to use their puzzle. But they've made their puzzle piece so tiny that it's not this big piece anymore. So I don't really say that. I just say these are the three main benefits that National Life Group likes us to share. So based on $500 a month, okay, this first part here, this purple section, this is your life insurance. If you die tomorrow, you're going to leave your family $309,000. This middle section is your cash growth. So let's say you stop putting money in right here at age 67. Well, here at 69, you've got $337,000 built up in your IUL. 74, 467, 646 at 79, and 891,000 at 84. So it's designed for you not to outlive your money, okay? And then your last section here is your living benefits. So if you became terminally ill, it's going to pay out a lump sum. Chronically ill, $5,401 a month for the rest of your life. Critically ill, critically injured, Alzheimer's, it's paying out a lump sum. So this is your living benefits. So let me ask you, do you have anything like this right now in your portfolio? Most of the time, they're going to come back and say, no. Would you like to have something like this in your portfolio? Yeah, I'd love it. Well, great. So all we got to do is just put in an application, see if we can get you approved. Might take a week, might take a month, all depends on underwriting. Doesn't require you to have any blood or anything like that. But let me just ask you, are you comfortable at $500 a month, or do you want that number to go down, to go up? Where are you with that? And no, 500 is good. Okay, fantastic. Well, let's do an application, see if we can get you approved. Okay, once they say okay, I click on this iGo e-app over here on the left. I put in whatever it is, and I hit save, and it brings me to the application. And that's that. And Felipe has his hand raised. What you got, Felipe?
Q&A.
Thank you. Thank you, Francis. Thank you for that illustration. What I've been coming across a lot, I'm not sure if other people have, I'm pretty sure you guys have. What do you do, or what do you pivot to with people that are a little late to the party? They're not 42. They're like late 50s or maybe even 60, and they give you like, I can only do like $100 a month. And it's like, that's we obviously know that's not going to work, but.
Right. I had a lady, she's 82 today. We put $100,000 in it, spread it out over 5 years, and it's still, I would have had to have spread it out over like 10 years for it to have done anything. Right. It was just going to keep lapsing on her. Okay. So what I do at that point is, see, it's probably going to time me out. Yeah, it's already timed me out. I would go back to the illustration. Okay. So for those of you that don't know, you can go back to the illustrations through GoTo right here. If you see this up top, all right, you could click on here and go all the way back to the home, the default page, the dashboard or whatever. But I would go, basically right here, and I would go home, and I would pivot to I'd come down here and I would pivot to like secure growth, fit secure growth, because you can put $100 a month in this. And this is an annuity. It's index annuity. It works like the cash part of the IUL without the life insurance. Think of it that way. And I would just put $100 a month and do it for however many months, 1 through 10 or something, Oops. You have to put in at least $100 a month, $1,200 a year. And you have to put in at least $5,000 over the life of it. And then you just pick, I do 50% here and 50% there. And then I run an illustration. Quick view.
Oh, you missed the first 50%. It didn't take.
Yeah, just it didn't take your 0.
Yeah. And then I hit quick view, and then I show them what it looks like. So that's all I would do. Yeah.
Oh, thank you.
Any other questions?
Yeah, Danny's got his hand up.
What you got, Danny?
A couple questions for you, Francis. One is, how would you address the 0 in that policy, first year surrender value? And then second, do you ever show them, or do you ever give them the option to show them the B option?
Yeah. I mean, for example, this is a lady I wrote a small policy for today. The 0 right here, it is what it is, and most people aren't trying to get money out of it right away. If they are, then yeah, we're probably going to go to the B option. We're going to increase it. Okay. If that's really all their focus is. Again, I'm trying to do what the client wants, but the way I address it, I just say, this is your money that's accumulating. This is your bank. All right. So you're not going to have anything that you can draw out of your bank year 1. Year 2, you got a little bit. Year 3, a little more. This lady's only putting $100 a month in, and she's 50-some years old, so she wanted life insurance. She has no permanent life insurance. So that was her goal, is to have, I don't even have her stopping putting money in. Okay. Even though she can, there's going to be plenty of cash growth here that she could make this a paid up policy at any time. But I mean, we were just, we were trying to get her life insurance. So I didn't stop it at age 67 or anything. Just go, she can stop it at any time that she wants in there. But I'm just going to, I just explain to them that there's nothing there year 1. That's pretty much it.
Right.
And
do you
then,
ever show them the other option, like when you're
and
doing
then,
something?
so like this was her daughter, and oops, this was her daughter, and so for her daughter, yeah, we're gonna do increasing. We're going to do it 1 year past, we're going to pay in till age 67, and we're going to do this at 1 year past. That is the lowest amount of beginning life insurance that you can structure by increasing it to change year 1 year past, putting money into it. And if you don't believe me, just put that number equal to this, and you'll see that your death benefit's higher. And so, in this case here, she still has 0, but girl's 12 years old. So that's why it's 0 year 1. Sometimes young kids, you might have 0s in 3 years, even though you've got it as low as you can on life insurance. But that's all right, So then stops putting money in. She still has $250,000, even at putting $50 a month in and never changing it. She's still got $250,000 when she goes to retire. Hopefully she would put more into that. But yeah, I'll go back and forth with people. Again, it just depends on, so what Danny's asking, if anybody caught that A and B, you see this says B increasing, A is level, B is increasing. And that's every company's the same. Mutual of Omaha, F&G, Transamerica, you name it. You know, all life and all index universal life. A is level, B is increasing. That's the universal symbol or whatever. You know. All right. Who's next?
I got a question.
Alicia. Well,
Oh,
go ahead,
I didn't
Oscar.
raise my hand. Sorry. Francis, when you said earlier that you can borrow, you gave us the example where, you know, if you had some type of property and you had to put down 5% or whatever it was, so it's like $10,000, right? And you also you came back and you said it's important that you pay it back because you want to get all the I guess you want to increase the surrender value. Is that what you said earlier?
Well, you know, if you look here, your accumulation value is 248,000. Your surrender value is 248,000.
Right.
Well, if this person, you know, in year, let's just say 35, okay, took out 50 grand and took out $50,000. Let's do that annual. Just want to do it a monthly. What I say, year 35. All right. You're going to see that the accumulation value is the same. So there's the 35 or 50,000. I'm sorry. I took 50,000 out year 35, age 47. All right. Well, they never paid it back. Where's our, age 68. So now, you know, you've got only 83,000 here and you still have 245,000. Why?
Yeah.
Because this thing has been eaten away at, you know, your accumulation value is only growing. In this illustration, it's only grown at 6.44 and you're paying 5.5% on the 50,000 that you borrowed. So, you know, it's still growing, but it's not growing near as fast as it could be if you didn't have all this interest being, you know, that you're being paid, that's being charged to you. Yeah, you're still making money on it. This is still growing, okay, but not growing near as fast. It's the difference of 245 versus 83,000. You know, you cost yourself a lot of money just taking 50,000 out 20, 30 years earlier. 30 years earlier.
Does it also matter if you take it out on the first couple of years of the policy being enforced?
Well, you don't have a lot. That's the problem.
Yeah.
But it doesn't matter. It doesn't matter. The suggestion is to pay it back.
The one that you were doing before, I don't think it was this one. It was the numbers were different.
No, it wasn't. Yeah, you had more money here, but that's why I went all the way down to here where you had a lot of money that you could pull out of it.
I see.
But all I'm showing you is that it's still growing, but it's not growing near as fast.
Yeah, it went backwards because you took out 50 grand. Right.
Yeah. Yeah. So instead of it having accumulated 200, 200 only accumulated 83 instead of being 245, it's only at 83.
Yeah.
So you lost almost 100 grand in interest, if you will, over those 20, 30 years.
That's really good because I know we on our, on the practice that we do, we bring up the fact that where you can borrow interest free, but at the same time, it's important to know for us to know.
Don't ever say interest free. Don't ever say interest free. You see this right here? 5.5%.
Oh, tax free.
Okay. It is tax free. You can pull money out tax free. It's not interest free. Now, we can set up a lifetime income. So here's the difference. All right. So I just yanked out 50 grand. All right. Now you can show them tax-free retirement. And the way you would do that is you would say sal for income. Make sure this is M. If anybody doesn't know, M means maturity. It's the maturity of the policy that's 120 years old, or when they die, or just when the policy matures. So you can do this monthly or annually. Let's say they're going to get a monthly income. They want a monthly income. They stop putting money in at age 67, and they're going to start drawing money at age 68. Okay. Now they're never paying this back. Okay. This is money that, $20,911 for the rest of their life, from age 68 till 120. They could draw on this policy and not run out of money. But it's the same thing. It would have accumulated $7 million, and now you have 889 in your surrender value. Yeah, you're getting paid 20,000 for 55 years, you know, so you paid yourself over $1 million.
Yeah.
All right. But you're still 6 million, you know. I mean, there's still a discrepancy there. However, that's okay. You've got your lifetime income. You only had 248,000 here, and you started taking 20 grand every year, and it kept up. It allowed you to pay all that out, you know, without running out of money.
Yeah.
So, and there's still more money there. You could actually use, you know, money throughout it. But anyways, this is designed for you not to pay that back. If you borrow money while you're paying into it, that's when I say you should pay it back. Just like you're borrowing from a bank. Pay the bank back. You know, they're going to make you pay it back. Why not pay yourself back and treat yourself like a bank?
Yeah. Thank you.
Yep. Any other questions?
I want to ask just one question, Francis. Number one, thank you for going through this again. I love how you go through this. Number two, the 5.5%, does that go to the insurance company? Is that where that interest goes? Just being sure.
Yes, and that's why the insurance company doesn't mind you borrowing out of your policy, because they're making 5.5. Now this float, this is variable. So 2 years ago, this was something like 3.9. It's gone up since the interest rates have gone up, and it'll go back down when interest rates go down. You know.
Okay, so yearly, pretty much yearly, they'll update it pretty much, or we just watch that percentage.
I've seen it change. You know, when we had all those interest rate hikes last year. Yeah, you watch this go up. Like, damn, did it again. Damn, did it again.
Yeah, I think it was 5.9 at one point.
And then it came back down. Yeah. So, but I don't know how often they do change it, but it is variable. It is a variable situation. Yep.
Thank you.